Hello again. So in this video we're going to look at some of the representative contracts for each area of the energy market. Okay, so let's start with crude oil options. One very important contract is the option on WTI oil. Okay, it's an American type of option. It is trading on the CME, and these are the characteristics of the option. So it's the underlying futures is the WTI futures. Each option is on one futures, and it is quoted in the same way as the futures itself. It's in dollars per barrel. Again, it's an American type of option. It's exercised into futures, as we discussed in the previous video, and it has the other characteristics you see here. So let me open the actual web page here. So if you go to the CME web page, you can look at markets, energy, and if you look here, the option we're talking about is this one here, the crude oil option. So it's one of the top products on this exchange, one of the most heavily traded, as you can see here by the open interest. So very liquid contract, right? And you can actually click through the link and see here the definitions, all the characteristics of this option contract as explained by the exchange. So again, I think this web page is of the CME. It's very useful. It gives you a lot of nice information. Okay, so let's see a couple more details. So just to make things clear, for each futures contract, you have a whole different bunch of options. So for example, on this specific date, 26th of April 2013, you have a curve of futures that start in June and extend out. But starting with the June contract, with the June futures, you can have, for this initial futures, you can have a whole range of options. So this futures is trading at 93. So this is let's think of this as the middle price of the table. And then around this price, you can have a bunch of decreasing and increasing strike prices, and for each strike price you can either trade a put or a call. Okay, so for one single futures you have this whole table of calls and puts. Then you move on to the next point in the futures curve, which would be the next contract, the July futures, and this was settling at 93.25, so here somewhere here in the middle of these two numbers. And again, you would see a big table around that figure with either strike prices going down or strike prices going up and the corresponding calls or puts. So you could trade all this table of options around that futures. And so on, you keep going through the futures curve, August and so on, all the future dates until the last one, which would be December 2021. So this was in 2013, so a lot of years after that. That last point in the futures curve was trading at 82.18, and again around that strike price you would have a whole table of options. Okay, so as you see, it's a huge market. For each futures you have a big number of options that you can trade. Right? So let's see how we can use this with a simple example on speculation with these options. Right? So let's say it's April 2013. We have a hedge fund that is very confident that the crude oil price will drop in the near future and wants to bet on a given quantity, let's say 10,000 barrels. Okay? The fund does not have any physical infrastructure to handle physical oil. This is a hedge fund, and they prefer therefore to trade in derivatives. So the trader, the fund manager, is considering the following alternatives. So the first one is to trade with futures. So the previous contract we talked about before. Okay, so if you think that the oil price will drop, you have to decide whether you want to take a long or short, or whether you want to buy or sell the futures. Okay, so stop the video, think about it for a second, and then the answer is you need to sell the futures. Okay, how many contracts? Well, recall that each future was for 1,000 barrels. If you want to get this amount of exposure, you need to trade 10 futures. Okay. Alternatively, now let's think about options. Okay, so if you want to bet on a price drop, meaning you want to make money, you want to profit if the price drops, you want to pick a put option, right? So think of the payoffs of a call or a put option gives you a positive payoff if the price ends up below the strike price. So if you want to bet on the price going to the left, going down, you need to buy a put option. Okay, and I already answered the first question. So you need to buy a put option. Buy how many contracts? Since each option is on one futures, and one futures is on 1,000 barrels, the number here it's again 10. Okay. Another alternative is to again buy a put option with 10 contracts, but notice here that the difference is that the strike price is lower. Instead of 93 is 90. So instead of being equal to the current price of 93 that you see the futures, is now lower, 90. The difference that the result that you get from picking this lower strike price is that the price of the option is also lower. Okay, the current put price is 0.77 rather than 1.77 for the at the money put. Okay, so let's see what happens in the future. Okay, depending on the price of oil or the futures price of oil at let's say at the end of May. Okay, so sometime from now. Okay. So depending on the price, you may make or lose money, right? So what we're doing here is comparing the linear contract, the futures, with these new alternatives, the non-linear contracts, which are the options, in this case, put options, okay? So if the price does not move, you get a payoff of 0 with the futures. If the price goes down, you start making money. If the price goes up, you lose money, okay? And so this can go down a lot and it can go up a lot. So the payoff here in the futures is linear. Okay. Actually, the amount, the maximum amount you can make with a short futures is limited. This would stop at the initial futures price. But the amount of money you can lose is unlimited. So you can just basically lose any amount, right? So there is no bound here on the right hand side. So this can go down. If you think of the futures, of the short futures payoff, it looks like this. So it can go down a lot, right? So that's the risky part here, right? So what happens with the call? With the call, you get something that is not as risky in the sense that this is the price where you break even. So it's not the same as in the futures because you have to pay the premium that you have to pay in the beginning to buy the option, the put option. So you need a price of not 93 but 91 to 23 to break even. Okay, if you are right and the price is even lower, you make money. Okay, that's good. The nice part here is that the loss you can suffer if you are wrong now is limited at the premium 177. So the worst case it can happen is that if the price moves against the direction you were expecting, you do not exercise the option, you go away with a 0 payoff in the end, and you just have a cost which is equal to the option premium that you paid in the beginning. We are here ignoring time value of money, but that's the idea. Okay. If you pick the other option, the 90, the put option with the strike price of 90, this would be the payoff you would get. You would need a price even lower to break even. You would only start making money if you were really right and the price went a lot down. Okay, but on the other hand, you do not lose as much if you are wrong. So you only lose 0.77 at the most instead of 177. Okay, so these are the trade-offs here. Some strategies are more risky than others. The usual risk-return trade-off. So this is the payoff in dollars per barrel. This would be the total payoff for the position the trader decided to take of 10,000 barrels, okay? Which is basically just these numbers times 10,000, right? Okay, so some other options for crude oil are these ones here. So this is just to give you an example of other contracts that exist out there in the market. This is not in any ways exhaustive. It's just again to illustrate that is the main option, but it's not the only option on oil, on crude oil. All right, we have options on other things. So here, refined products options. The two main refined products we talked about are heating oil and gasoline options. These are their characteristics here. These are both CME options on the corresponding futures. The website is, again, very nice. Let's briefly look at it. So if you go here to refine products, you will have here futures, then here New York Harbor. This is now called diesel option. At the time I wrote the notes, this was called diesel option, but it's the same thing. So this is the option we're talking about, one of the most heavily traded options here. And then there is also the gasoline option down here. Okay. So these are the two products we are describing there in the notes. Again, click through these links if you want to look at the properties of the contracts, which are again repeated here in handouts. All right. Natural gas options. One very important is the option on the most important derivative we have discussed before, which was the Henry Hub future. So we now have an option on that futures. The characteristics are as we have here. This type is European, which is not the most common type, but again, as we said before, there are some options which are European, right? Again, you can come to the CME page, and if you go to natural gas, you will find here the natural gas option. It's this one right here, the one here. Okay, and as you see here, this is actually a very heavily traded derivative. The amount of open interest is even larger than in the futures. It's quite heavily traded, right? So, quick example here. Now for hedging natural gas power plants, this is the same type of setup we have seen many times before in this course. So we have a power plant that uses natural gas to generate electricity. Another scenario is the following. Let's say that the plant is located in the southern US, where you have hot summers that usually drive up the price of natural gas due to high demand for air conditioning, right? You have to use electricity to generate you have to use electricity to have air conditioning, and therefore you have to buy a lot of natural gas, and therefore the price of natural gas is high, right? The plant usually buys gas at Henry Hub spot prices, okay, because it's in the southern US. Let's say it's April 2013. So the scenario is the following. The manager believes that July will be extremely hot and wants to hedge the price of this amount of gas, okay? And so now this is I think an interesting example, because it starts to talk a little bit about the nuances of why you may want or not want to hedge. Okay, so the reasoning here is the following: if the manager is right, okay, meaning the summer will be hot, the plant will make a nice profit by buying gas at a relatively low price. I mean, if he hedges, and selling electricity at a marginal price that will likely be high. Let's assume that the competitors usually do not hedge, so now you have a lot of demand for electricity. You go up in the generation stack. The last guy that is dispatched is an expensive generator that will clear the market at a very high price. And if this plant that we're looking at has hedged, then it will be very good for them, because they will be selling at a very high price, and their input cost, since it is hedged, will be low. Okay? However, the manager does not want to lock in a price, because the local market is very competitive. So if natural gas prices actually went down, okay, the plant would be forced to sell electricity at a low price to remain in the generation stack with a fixed input cost. So if he had hedged with a linear contract like a futures, this would lead to losses. Okay, because he would not have the optionality that an option will give him, right? So, and I just answered the question. The manager chooses to hedge with what? It chooses to hedge with options rather than futures, right? Again, the idea is that if you use an option, if the situation evolves in the right way, you benefit. If the market evolves in the opposite direction, you do not lose, because you are not locked into an outcome like you would be if you had chosen a futures. All right. So obviously, nothing is free in life, let alone in financial markets. So there is a cost here, obviously, right? And the cost is that to get this optionality, you have to pay a premium at the beginning. Okay, right? In the futures you don't pay anything to start, but in the option you do pay a premium to start. Okay, so think about the strategy you would use in this condition. But I mean, the main point here is to decide options versus futures, and then what could you do with the markets that we have quoted in the previous sections. Okay. So finally, electricity markets. We also saw before futures on electricity. We looked at one particular future, which was the PJM futures, and now there is an option on that futures as well. Okay, and these are the characteristics here. Again, it works in a similar way as the previous examples. It is an option on one of those futures we discussed before. Okay, it's again back to the usual kind. It's an American option, and it's exercising to futures as we've been discussing. Okay. All right, let's stop here.